Rajat Monga, Chief Financial Officer and Senior Group President of Financial Markets at Yes Bank, is joining us. Good morning, Rajat. Let me start with where you will give me positive answers, hopefully. Is the cost of money falling? Wholesale or retail?
The cost of money is, I would say, more than falling or rising. I think it is getting entrenched at 8%, which is what RBI policy is reinforcing more and more. And as we saw liquidity get better in the last 2-3 weeks, RBI has been proactively introducing the reverse repo windows, which also sucks away the excess liquidity, and again calibrating it such that the clearing price is as close to 8% as possible. So I think the difference between the last few quarters, particularly from 1 year ago when we were in a very disorderly interest rate environment, is that the environment is now stable and well entrenched at 8%. Cost of money has been range bound. It is just that the volatility of cost of money is definitely coming down, getting more predictable, but I don't think I can yet say that the cost of money is falling.
Mr. Monga, we're trying to assess the improvement that we've seen on the ground. Has there been an increase in lending activity by the bank in Q2 or in Q3? You know, let's talk about 6 months. If you can't give numbers, what will be the lending growth or the advances growth? Will it be better than what we saw in the last 2 or 3 quarters?
Yes, I mean, as you would have seen that the bank, at least Yes Bank, has raised more capital in the first quarter of this fiscal year. So we may be a little bit more peculiarly placed that we can put more growth on the table than the other banks could, and you will see that in, I mean, our first quarter numbers also had about
23% advances,
23-24% advances growth. I think that trend, at least from our standpoint, will continue. This quarter it might get better because last year's base was a little hurt by RBI sort of developments at that point in time. But I think the trend will be a little bit on the higher side because we have more resources. Opportunity is definitely increasing. It's not that the opportunity is coming in and pouring in, but the quality of the opportunity is increasing. If nothing else, the new government is at least enabling the problem solving in the banking asset environment, and that's also creating financing opportunities. So the calls with customers are increasing, the queries are increasing, while transactions are still
so 25 to 30% advances growth for FY15?
I would look at, for Yes Bank as such, closer to 25%. I think the industry is still looking
13%.
Similar to last year. But we are dealing with a base issue. So the base is noisy. Like I was mentioning about on the interest rate side, it is also noisy on the loan side because similar period last year, banks' loan growth was heavy because of the disintermediation that money markets were having. So banks were having to lend more. So it will normalize. I think this is currently a base period. So hopefully closer to 14-15% for the full year at an industry level is, I think, looking likely.
Even where they're somewhat safe, like home loans, we saw a little bit of chugging down of lending rates. HDFC did it first, ICICI Bank had done it earlier, and then SBI had to follow suit. They had no choice. So, I mean, I don't know. Loan growth is looking a little dicey from what Mrs. Bhattacharya spoke to us recently. But I was more interested in the quality, asset quality.
Right.
Recent brokerage notes after they met some banks, notably Axis and ICICI, indicated stress appears to be decreasing. Are you getting that sense? I mean, you write a lot of loan guarantees, performance guarantees. Are you feeling safer on many of those?
Well, let's say our primary exposure is and by far is largely loans. Guarantees is, let's say, a smaller, much smaller proportion. But guarantees is, we don't look at guarantees in isolation. Guarantees is as much a working capital for any company that otherwise a funded facility. It's a life cycle product. So when a company imports, it first will need a contract. To get a contract, you need a bid bond. So that becomes a guarantee. Once you get the contract, you need a performance guarantee. Once you start executing the contract, you need to import some equipment. So you need an LC. Once your LC has to be paid because the equipment has landed, you need a loan. So it's actually all the same.
Yes.
The difficulty is if you're doing standalone bank guarantees or standalone LCs, which is something that at least we as a practice don't believe in.
Okay.
So as an asset quality subject, you will have to look at them all as, I would say, a pool, with varied symptoms as such. So your question in terms of whether the stress is increasing or decreasing, I think the definition of stress also varies, but decreasing is a good assessment by various definitions. You will not see it appearing in lowered NPA numbers. You will first see appearing in lowering credit costs for banks. So they are now having to
provide less.
They're getting more NPAs, but they're getting less more NPAs. So they are having to provide relatively less. I would hazard that this year the asset quality or NPA numbers of the banking sector as a whole should see small increase from last year. It will still show an increase, but the affordability is getting better because banks will be able to yet put aside more money to afford the NPAs. The problem accounts are not growing. Most problems are known, well identified, and the problem solving process is definitely improving. We're already seeing asset sales by companies. M&A is not yet begun, but M&A should also pick up. Capital markets are open. So de-risking is taking place. So it's, I think, a safe measure to, at least safe way to say that the stress is reducing.
The capital raising that you all did should also benefit your net interest margins. In Q1, it stood at about 3%. By how much could your NIMs rise, at least till the end of FY15?
Well, the capital should give a 15-20 basis point NIM sort of leg up, and as such, we should. Some of that should come through as soon as the second quarter. First, while we raised the capital in the first quarter, but it was towards the end of the quarter, so we will see the effective. But that's not classical NIM improvement. NIM improvement, which is already happening, will happen from operational improvements, CASA going up. So in the last 2.5 years, our CASA has moved from 10% to 23%. That is the NIM, strong NIM factor. And that should continue to be better. We are looking at a 3 to 5% improvement in CASA per year, which is a 10-15 basis point NIM improvement per year. So NIM is looking, actually in the medium term, if you allow me, not this fiscal year, NIM is looking 30-40 basis points higher.
Okay. How will your corporate bond portfolio do? Because you'll have a decent one. I mean, in the first quarter, it showed up in terms of some losses.
Very decent one, yeah. So it's a very decent portfolio in the sense that the asset quality is very pristine. This is a portfolio.
So this quarter, it might recover those losses. Did corporate bond prices rise?
Well, we actually, if you look at a quick historical context here, we would have at our worst provided for about close to 100 crores on account of mark-to-market provisionings for both corporate bonds and government bonds, which is
you will take them off this quarter?
It's already off.
Okay.
So
that is in Q1 we saw a bit of provisioning.
Q3 in Q3 last year we took some off because short-term rates began to sort of fall back in line, and Q1 in this fiscal year we have taken the remaining part of as well. In fact, you are right back in Q1.
So your credit costs will, I mean, your overall income could go up because you have to provide less in Q2 itself?
No, there is no impact in income because the portfolio is now, so Indian accounting on bond portfolios is one-sided. You provide for losses, you don't provide for income. So it's already in a gain-like structure, so it will all get ignored unless realized.
All right, I think we'll have to leave it at that. Okay, are you raising any infra bonds?
Well, we will, in the sense that our, so infra bond has two parts. One is the historical catch-up. We don't have a whole lot, so that's a small portion for the existing infra book. The new is more exciting, which is more affordable housing oriented and also new infra lending oriented.
So you'll buy home loans?
Not really. I think we should.
I mean, it's a faster way to do it, that's all.
Well, it's arguable. I mean, it is. I'm not sure that is the design of the regulation, that we buy from HFCs and then take concessions. I don't think that will fly well.
So we will see you expanding your home loan portfolio.
More like, yes, absolutely. We also want to get into home loans. It's a good contextual opportunity. That's among the reasons why pricing in home loans is falling.
Already falling. Okay. All right. Thanks a lot for that story and for spotting that trend for us. Thank you, Rajat, for joining in.